We've talked about a lot of companies in the S&P 500 reporting this week, more than 150 of them, and a lot of them are the largest companies within technology. Let's preview some of those numbers with Jason Helfstein. He's a senior analyst at Oppenheimer. Jason, good to see you. Of the tech companies, one of the only clues that we've gotten so far, perhaps, is from another company, Snap, that reported last week. Is there any read-through from that to the likes of Facebook and Twitter, or is it sort of an entity unto itself and we can't extrapolate?
No, look, I think you can always find the derivative. I think the main thought going in is street expectations, professional investor expectations for Snap were sky high going in. And while they gave good guidance, it did not meet where we think most fund managers were at, yet the stock still rallied. So I think that suggests a very good setup. Like there's been this, how do we climb this next wall of worry around expectations, because we all know the economy is getting better, advertising is cyclical, but what's baked in? So we thought actually the market's reaction to Snap was actually very bullish for the rest of the tech stocks.
And Jason, I know we're talking about the tech stocks in general, but I just want to drill down a little bit more on Snap and the story around that company and the way it's changed over the last couple of years. How you're thinking about the story today. The top line growth that they're discussing at this point in their corporate history, I think is probably even maybe a surprise to them, and sort of where the Snap story goes from here. I think it was only 2 years ago it was a single digit stock, and now it's 60 something.
Yeah, look, I think you have several factors, right? So the first is they basically kind of got the company on a professional product trajectory, meaning, line of sight, we want to put out X product. Let's put a timeline, let's get it out. So the cadence of getting product out, right? And they talked a lot about the whole Android upgrade, just as an example, but just broadly, right? They fixed the plumbing in the business. Next, they ramped their sales force, right? As a result, they can now go to advertisers, effectively say, this is why we have that target audience for your product. This is why you should spend money with us. Then you're now seeing them kind of innovate on the product, right? So if you think about it, they are probably in the best position amongst all the digital advertising companies to leverage augmented reality in advertising, right? Given their demo, their younger user base, they're more likely to experiment with camera as a kind of tool for product try on and et cetera. And while we do expect other companies like Facebook to be a fast follower there, I just think Snap has the perfect audience. So really, that sets up a pretty interesting story. Then the next leg would be the Maps product, which has really good user engagement, but not really any revenue associated with it. And then even kind of Evan on the call talked about kind of getting kind of Snap technology in other third-party hardware, like in Samsung phones and that augmented reality. So, when you think about where this is all going, this company is just very well positioned, and their monetization is still well less than Facebook, and investors like that outlook.
And Jason, switching gears to Amazon, what's the one thing that investors want to see from Amazon on its earnings day that would get the stock going higher again?
Yeah, look, there's been some questions about, are they losing share to other cloud players, namely, Google and Microsoft? What did COVID do to cloud? We think COVID has actually accelerated cloud migration, right? You had probably a whole bunch of CTOs who were like, we wish we had done this migration faster to the cloud. And on top of that, while you did see certain companies probably see more usage of the cloud, there are a whole lot of companies who cut back usage. So we think actually the cloud story is pretty well set up, and investors are probably not worried about that, which was, I think, a worry maybe a year ago. It's probably more of, did Amazon take so much share during COVID and people buying shampoo online for the first time that as the economy is reopening, that they're going to lose share? We've always found in e-commerce, the genie never goes back in the bottle. Yes, people will go out and about in their lives, but at the end of the day, is buying shampoo in a store enjoyable? And so if it's such an easy thing and a habitual thing you've now kind of done online, you'll just keep doing that. So I think that's the biggest question. I think investors know they're going to have a really big ad quarter, which is super high margin. And I think the last thing probably that's on people's radars, they spent a lot of money, call it, I think it was $9 billion all in on COVID related costs, and kind of where does that money go? And so, we don't think it's going to go to the bottom line. We think they're going to try to reinvest it. And the question is, where does it go? Does it go into grocery? Does it go into pharmacy? They have kind of some ambitions around healthcare. And so I think investors would like kind of understand how that affects the story over the next 12 to 18 months.
And finally, just quickly, I think Alphabet is the one that we didn't touch on quite as much. Presumably some of the ad trends that are going to help, Facebook, even Amazon and the others are going to help Alphabet most of all, perhaps. I don't know. Who stands to gain the most from the surge in ads?
Yeah, I mean, we think expectations are actually the lowest for Alphabet, partially because it's been the most obvious reopening stock, right? They have the most exposure to travel. They have the most exposure to local. And so we think, to the extent you would think expectation would be higher when we've done kind of our own work, we actually think within kind of the tech group, it's actually the best setup into earnings. Look, a lot of people have looked at kind of Alphabet and said this company is just so big, can it keep hyper growth? And they just have this kind of ability to surprise. We think their advertising is going to be up 26% this year, which is 2 points above the street. And we're looking for 17% next year, which is 5 points above the street. So we like that setup. The stock's not expensive. There is, if you look at what some of the other pure play ad tech companies are trading at in the market, kind of Alphabet doesn't get the same credit as some of those companies. There's going to be some noise, I think, around the changes they're making to Chrome, with kind of going cookieless in Chrome, et cetera. But at the end of the day, we think it's probably the best reopening play within the advertising sector.
Very interesting stuff. Thanks, Jason. Jason Helfstein of Oppenheimer. Appreciate it.